In New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
That's right. Good morning, everyone. Stock futures trading higher this morning as investors price in an earnings beat from Bank of America, plus better than expected retail sales for June. So let's get to it with the three things that you need to know this Tuesday morning. Yahoo Finance's Jared Blickry, Madison Mills, and Rick Newman have more.
Thanks, Brad. Bank of America and Morgan Stanley rounding out big bank earnings this morning as the financial sector hits an all-time high. Bank of America topping Wall Street earnings expectations for the second quarter. Net interest income, a key metric for banks, it fell from the prior quarter and the year, but Bank of America says it expects the figure to climb in the fourth quarter. Morgan Stanley also beating on the top and bottom lines, but shares are lower as the company's key wealth management division misses on revenue for the second quarter.
And digging into those retail sales coming in unchanged for the month of June, defying Wall Street's expectations for a 0.3% decline. That new data showing the consumer continues to spend despite signs that the U.S. economy is slowing. Retail sales for May were revised higher to a gain of 0.3% from a prior reading of a gain of 0.1%. June sales, excluding auto and gas, also coming in higher than estimates.
And former President Donald Trump has selected Ohio Senator J.D. Vance as his running mate on the Republican ticket. Trump made the announcement in a Truth Social post Monday afternoon, the first day of the Republican National Convention in Milwaukee, and 2 days after surviving an assassination attempt at a campaign rally in Pennsylvania. Trump then showed up at the RNC convention, his first public appearance since the attack. Trump got an official endorsement from Elon Musk in the wake of the shooting, and according to the Wall Street Journal, Musk plans to commit around $45 million a month to a new super PAC backing Trump's campaign.
Our top story today, we are watching shares of two top trending tickers on Yahoo Finance, Bank of America and Morgan Stanley, both out with second quarter results. Let's take a look at some of the highlights here, and we're taking a look at this market action here beginning the day. The biggest mover that we're seeing right now, Morgan Stanley as of right now, and then additionally you've got Bank of America moving to the upside by about 0.8%. Let's just briefly hit on Bank of America, a few of the takeaways that I was able to peruse through this report and ultimately kind of pen down as some of the bullet points that investors may be thinking about this morning. Number one, looking at some of the year-over-year comparisons, even though you did get a beat on top and bottom expectations, there was an overall lower performance versus last year. Revenue, they did say, was hit by some lower deposit balances. You also saw the provision for credit losses up annually and sequentially here. Now, that could mean that they're just kind of trying to get ahead of where they could see some weakening in the consumer, but ultimately thinking about that consumer as well. On the digital front, for all you Zelle users out there, you're powering some of these new records. Digital usage strengthening for the bank. New Zelle records here, they did note of 22.6 million active users, that's up 11%. And then ultimately some sent and received 382 million transactions worth $115 billion. Both of those markers up 26% here, Shauna.
Yeah, I think the big mover, the big reason why we're seeing this reaction in Bank of America has everything to do with net interest income and where exactly Bank of America sees that going here for the remainder of the year. Because net interest income, when it comes to that, Bank of America is saying that they expected to hit a trough here in the second quarter. The second quarter net interest income will probably hit a trough here for 2024. And then looking ahead, their company is saying that net interest income on a fully taxable equivalent basis is probably going to climb to about $14.5 billion in the fourth quarter. So some improvement down the line. I think that's giving Wall Street a bit of confidence and why we're seeing Bank of America shares up just to over 1% here in early trade or in pre-market trading. Now let's flip over to Morgan Stanley because a different reaction going on there. You've got that bank under some pressure here following the results that we got out this morning. We're looking at losses of just around 3.5%. The big reason for that is some of the weakness that we are seeing in the wealth management business. Revenue there missing expectations, coming in at $6.79 billion. Now the bank has really been under a tremendous amount of pressure to show that it could keep some of the momentum alive within the wealth management business. It's going to be able to keep expanding. It's already market leading share that it does have here under their new CEO Ted Pick. So some weakness weakness there is a bit of a caution, raising some red flags here for Wall Street. So why we're seeing that stock under a bit of pressure. Also, the company here, provision for credit losses coming in more than expected. On the flip side, though, there are some areas, some bright spots within this report. That top line there, trading and net interest income at least beating the street's expectations. So able to maybe cushion some of the fears that we are seeing play out on the street. But again, a lot of this movement that we are seeing in pre-market in direct reaction to this report is related to some of the weakness or loss of momentum that Morgan Stanley is seeing within its wealth management arm.
Yeah, it ultimately seems like, and kind of continuing trying to get the read on where the executive officers for both of these banks are kind of remarking on what they're seeing in the broader environment right now. Ted Pick, as we were talking about Morgan Stanley, the chief executive officer over at Morgan Stanley, really remarking on this as a strong quarter, improving capital markets environment, which is actually something that many of the banks that we've heard as a through line from many of the banks have performed well because of the stronger capital markets environment, and equity markets as well is something that's been a boon for many of the banks at this juncture. But just to come back to that figure that you were mentioning on the wealth management side here, because that came in lighter than expectations, and ultimately here it was the equities and sales trading revenue that outpaced some of the expectations or estimates coming in to this quarter. And so where they're able to retain some of the wealthier clients, some of those who are looking to kind of rely on the services of the larger banks, I think that's been one of the other common denominators that we've heard over the course of this earnings season, at least for the financial services industry thus far.
Yeah, you're exactly right. We'll see where these two banks open here at the opening bell in just about 24 minutes from now. All right, let's take a look at retail sales coming out this morning, flat for the month of June, and May retail sales revised upwards to 0.3%. That was up from the initial report of 0.1%. Now signaling that the consumer is at least stronger than what Wall Street had feared. So here to discuss, we want to bring in Robert Sockin. He's Citi's senior global economist. It's great to have you here, Robert. So I guess when you take a look at this report, how do you think Fed officials are looking at this? Once they go through the tea leaves here, are they at least comforted in the fact that maybe the consumer is holding up stronger than initially feared at this point?
Morning. Thanks so much for having me. I think that is the key question. And I think for the Fed, what this will show is that the consumer is holding up well and is not falling off a cliff as some analysts had feared. You know, the economy was very strong in the second half of last year, and the big debate in the first half of 2024 was, were we seeing a sharp slowdown in the economy or a moderation into more modest, sustainable growth? And I think what this report shows is that the consumer is holding in there well, and maybe is not spending at the heady pace that we saw in the second half of last year, but is certainly not falling off a cliff. And I think for the Fed, this will take some urgency off of easing rates out of fears that the economy may be slowing down more sharply. So I think they're going to still signal at the July meeting the September cut is very likely given progress on inflation. But if the economy continues to hold up well, they can afford to be patient and probably move relatively gradually with rate cuts after September.
But it sounds like they don't need to wait for inflation, or at least their core kind of tracking of inflation, whether that be via CPI or PCE, to get down to 2%, as that would perhaps mean that they stayed too tight for too long.
Yeah, absolutely. And I think you've heard that from the Fed as well, that they feel that they've seen enough progress on inflation to get ready to start easing policy. I think in the first part of this year, you had several months of much stronger than expected inflation, and that really pushed out the idea of rate cuts. Now you've had several months of pretty good inflation. And yes, on an annual basis, by the Fed's preferred measure, we're not back to target. But I don't think that's a precondition for them to start easing, that they think that they've seen enough progress that inflation's moving sustainably back to target, and they're ready to start easing up on that very restrictive policy. So I think that's probably what we're going to hear from them when they meet this month.
Robert, so are you confident, I guess, that the U.S. economy is going to be able to avoid a recession? And if so, then what does that mean for Fed rate cuts, or the number of times we could see rate cuts happen here before the end of the year?
Yeah, and absolutely. This is still the key debate. You know, our U.S. team here at Citi still expects the U.S. to go into recession this year. And so in their base case, that leads to a lot more urgency from the Fed And after the first rate cut in September, they have them easing at every meeting after that, going into next year as well. Now, as I mentioned, it looks like to me from these data, the economy has moderated, but is holding up well. And so far, any of the indicators that are pointing to a heightened risk of recession are still fairly modest at this stage. Consumer spending has slowed somewhat, the labor market has loosened somewhat, but overall the numbers are still holding up quite well. So I think there's still recession risk out there, but to me, the data are feeling more like that soft landing. And as noted in that soft landing scenario, the Fed still cuts in September, in my view, but probably only cuts 2 times this year and maybe a few times next year. So I think they're going to ease, but probably at a more gradual pace than if the economy goes into recession, in which case they'll start easing much more rapidly.
Robert, if we do see the Fed ease at a more gradual pace, I guess my question to you is then what does that signal, or does that complicate the easing path or the path forward here for central banks around the world, and how so?
Yeah, and I think this is the key debate within global macro, what it means for the global economy. We've seen many central banks around the world start to ease ahead of the Fed. This is fairly unusual. We saw the ECB cut in June. We've seen the Bank of Canada cut, a variety of other developed market central banks. Of course, several emerging markets had started easing a fair amount before that. In this cycle, clearly there's a lot of domestic factors that are driving what these central banks are doing. A lot of this inflation that we're seeing in all of these economies is driven by services sectors, which are more domestically oriented. That being said, we still think that central banks have shown a preference for moving together when they can. And if the Fed stays higher for longer, there's only so much, I think, that many of these central banks are willing to deviate from Fed policy. So in our base case, where the Fed starts easing fairly consistently after September, that makes the lives of other central bankers much easier. They can start easing fairly consistently in tandem with the Fed. If the Fed is higher for longer, I still think you'll see rate cuts from these other central banks, but they're going to move more gradually as well out of fear of deviating too much from the Fed. So what the Fed does here, very important for the US, but also very important for global monetary conditions.
All right, Robert Salkin, Citi's senior global economist. Thanks.
Thank you.
Former President Donald Trump officially announcing his running mate for the 2024 election. Ohio Senator J.D. Vance was announced at the Republican National Convention, the RNC, on Monday, in his first public appearance since the assassination attempt against former President Trump over the weekend. Wall Street weighing in on what this could mean for the market. TD Cowen calling out likely focuses on trade, fossil fuel, and tough stances on China. Yahoo Finance's Rick Newman joins us with the details. Hey, Rick.
Hey, guys. J.D. Vance, not exactly a friend of big business. Like Trump, he favors more protectionism. He is pro-union. He favors moves that would push up union pay and blue-collar worker pay. He's got some backing in Silicon Valley among what you might call the libertarian wing of the tech industry, Peter Thiel and people like that. But he actually thinks some of the big tech companies ought to be broken up. So he's not exactly a tech bro in the traditional mold. Let's keep in mind that a vice president's policies and views usually don't translate into any kind of actual federal action if that guy actually gets elected. People kind of forget about vice presidents unless something happens to the principal, obviously, in which case he would step in. So I think one way to think about J.D. Vance is he is the future of Trumpism. He's only 39 years old. He is a millennial. So the millennials finally have somebody on a national ticket, whether this is the person they envisioned or not. You could kind of say to yourself, hey, Democrats, maybe you should get some fresh blood in there to counter the millennial who's on the Republican ticket. But at the moment, that doesn't look like it's going to happen.
All right, Rick, let's talk about some of the donor aspects. And we're hearing from some big billionaires, one being Elon Musk, saying that he is pledging to donate at least $45 million per month to help garner some support and elect Trump in November. My question to you is, what ultimately do you think this could then mean Is this a good thing for Trump? Could this actually backfire and actually favor Biden? And also, is there a risk here? Because you had some good tidbits that you pointed out here in an email that you sent to everybody. But what ultimately this could also mean for maybe Tesla down the line?
Right. So there's a lot going on there. If Elon Musk does give $45 million a month for the next 4 or 5 months, I think that might make him the biggest political donor ever to U.S. political causes. Now, his money would go to what are called super PACs. These are the organizations that in this case, I think would do stuff like they run ads. They can run a lot of ads in favor of the candidate they're aligned with, which is Trump. They can also run ads attacking the opponent, which is Biden. Some reporting suggests that this group will be focused on trying to get people, more people registered to vote. Get more people doing early voting, which is ironic because Trump himself has said that that's fraudulent, which it is not, but that's been Trump's view. And for Elon Musk, he's clearly getting way more deeply involved in politics than he ever has. Up till now, according to him, and I think according to all the records we know about, he has never given any meaningful amounts of money to any candidate or any cause, but he has become increasingly vocal and outspoken on political issues. Musk supported Joe Biden in 2020, if you can believe that. He had kind of a falling out with Biden because every time Biden talked up electric vehicles, he left out Tesla. He would talk about what Ford and GM are doing because those are unionized companies. Tesla is not a unionized company. Elon Musk took umbrage at that, got in some spats with Joe Biden on Twitter, now called X. And now he's all in on the MAGA presidential candidacy. There has been some research showing that consumer interest in buying Tesla automobiles has declined as Elon Musk, the CEO, has gotten more vocal on political causes. So I think this is going to be a very interesting test case. I mean, it almost never happens that you have a CEO of a publicly owned company. Certainly, you do have some of privately owned companies, but publicly owned with shareholders, where the CEO is basically picking sides in a very divisive political environment. So it makes me wonder, is the brand Tesla going to become like a subsidiary of the brand Trump? And are Tesla automobiles now going to become like Republican vehicles? Who knows?
Who knows? We'll see how this all plays out in the coming months. Rick Newman, as always, thanks so much.
Bye, guys.
We are just getting started here on Morning Brief. Match getting a boost after activist investor Starboard disclosed a stake in the company. They're also pushing for major changes. We're going to break down some of today's top trending tickers. And more big bank earnings this morning. We'll speak with an analyst later on this hour about who is best positioned following results from Bank of America and Morgan Stanley. Plus, stay tuned for our 10 a.m. hour of Catalyst. We will break down the risk of higher volatility ahead of the presidential election. All that and more. You're watching Yahoo Finance.
Time for some trending tickers. Match Group shares, they are rising this morning after activist investor Starboard announcing it has a 6.5% stake in the company. The Wall Street Journal originally reporting Monday that the hedge fund is pushing for a possible sale should turnaround efforts fall flat here. Shares moving higher here pre-market, as we mentioned, and of course, as we're thinking back to what's taking place more broadly with Match, you've got some headwinds that subsidiaries, and this has a host of subsidiaries. We should mention Match is more than just the Match.com that you knew in the early 2000s. Now, of course, the parent company owning Tinder, plus a plethora of other dating apps. OkCupid, plenty of fish within there as well. But more largely here, some of those consumer discretionary dollars that have really been relied upon for growth of the average revenue per user. If you see persistent headwinds within that, that's where you could see more of these activist groups actually be successful and not satisfied with some of the turnaround plans that have been attempted to be put in place. Elliot, one of those other activist groups that's within this name right now.
Yeah, it's the third activist to take a stake within Match this year. So really showing that there has been a much push here for change at Match. This is a company, like you were saying, has been struggling now for quite some time. We had that 1 year chart up on the screen just a moment ago. Shares are off just about 30%. And this is an issue that's not only with Match, but some of the weakness that we're seeing more broadly speaking within the dating app sector. We talk about the fact that they're slowing growth almost across the board. Stiffer competition, that's obviously complicating efforts here to increase the market size, something that's not just Match is struggling with, and also just tough times retaining the paying user here. And we bring that up because we just had retail sales out before the bell. Yes, they were flat, coming in better than expected, but not necessarily pointing to a consumer that is very strong and is out there willing to spend. So we talked a lot about this K-shaped recovery, maybe that we are seeing play out within the economy, this big divide between the have and have not. So we are seeing consumers maybe pulling back on some of their spending plans here. And as a result, many of these names, Match included, is suffering a little bit as a result.
Yeah, J-Lo once said, love don't cost a thing. Match said, hold my beer.
Costs a lot.
Yeah.
All right, well, UnitedHealth shares moving higher this morning. That was good.
Well, I tried.
I mean, let's start up from the top here. United shares moving higher this morning, reversing course after its mixed second quarter report left investors concerned about higher costs in the wake of a cyber attack on one of its affiliates, Change Healthcare. Yahoo Finance's Anjali Kamani has the details for us. Hey, on.
Hey guys, yeah, United kind of a mixed results morning right now, missing just slightly on estimates for revenue, but beating on adjusted EPS. Now, what we know is that investors have been really watching this Change Healthcare story very closely. It has been one of the biggest uncertainties hanging over this company for this year in particular, in addition to a number of other things. So when we look at the Change Healthcare impact, not only has the impact been greater than expected, 1.1 billion in the quarter alone, and that's a majority of what the company estimated would be 1.6 billion for the entire year. So already hitting quite a high number there. Not sure if it's going to continue to be a major expense for them throughout the rest of the year, or if it will taper off in the second half. But we did hear from the CEO on the earnings call this morning, allaying a lot of fears about some of the other things weighing on the stock this morning, and that includes the payer mix, the patient mix. So whether or not they have a majority Medicaid, Medicare, or commercial patients, members on their roll, and that has changed. There's been an increase in the commercial side and utilization there. So that's another thing investors have been looking for, whether or not that will decrease throughout the rest of the year. We heard from Mizuho's Jared Hole saying that the key from here really is how management sounds with respect to the pace of utilization, which I just mentioned, over the next couple quarters. Investors are looking at whether or not it plateaus, goes down, et cetera. So that's sort of the key here, is multiple moving parts. And just a side note really quickly, I also heard the CEO talk about AI and sort of the use of helping drive down costs, but not in the like ChatGPT kind of way, right? Yeah. Not in generative AI. It's more on how technology is actually helping to drive down costs, even though they've gotten in trouble in the past over that. So really interesting to see how they balance that tone with the issues.
Who's gotten in trouble?
UnitedHealth. So they were using AI to handle Medicare Advantage claims, and that had been leading to a lot of denials, and so they got into trouble over that.
Well, it seems like those days claims payable, that actually moved lower, which is a good thing.
That's a good thing.
About 45 days compared to 47 in the first quarter. So, Anj, thanks so much for tracking all things UNH here on the day. We'll track those shares throughout the rest of today's trading session.
All right, Shopify shares getting a boost after Bank of America upgraded the stock to buy from neutral, raised its price target to $82 from $78. The analyst behind the call saying, quote, revenue growth and disciplined spending point to healthy margin expansion going forward. They called out the fact that under their new CFO, that Shopify has made a number of, taken a number of steps in the right direction, turned a quarter on balanced growth on margin here going forward, saying that they do see solid revenue growth, free cash flow conversion also improving there. So because of all that, I guess they're pretty bullish on what the outlook here, at least, or what the road ahead looks like for Spotify. We are looking at year-to-date losses of just about 17.5%. So they are making the bet that we're going to see a bit of a turnaround there in shares.
This is a huge story for Shopify, and here's why. I mean, if all your social media companies are essentially the new mall where discovery happens digitally for a lot of potential consumers out there, or those who are trying to find inspiration and then conversions act on that inspiration and make purchases, Shopify is very intertwined within that experience, and it very well could be the new major purchase and point of sale operator here that we're continuing to see grow upon what it's already been able to do. Now, the key thing that they're calling out within this is free cash flow. The company talked about this in their most recent earnings call. They expect that free cash flow margin to be similar to the first quarter of 2024. But this analyst is actually expecting upside to Q2 revenue growth of 23%, pointing specifically to better scale and free cash flow conversion here. So ultimately, that's the number, that's the figure to track once we hear from Shopify this particular earnings period here, once they give us those results. That not expected for a little bit of time here. We're early innings in this earnings season.
Very early. Just getting through the banks. Yes. Still going. All right, we'll keep right here on Yahoo Finance. Also early on in the show, we've got the opening bell coming up next. Keep it right here. We'll be right back.
Just seconds away from the opening bell, you're taking a live look at the NYSE, where Michelob Ultra is ringing the opening bell. Ticker symbol BUD, of course, Budweiser subsidiary there. And then taking a look at Simply Good ringing the opening bell at the Nasdaq here. All right, that is the opening bell. You're watching the morning brief. It's brought to you by Invesco. Let's do a check of the markets here as we begin this Tuesday trading session. We're taking a look at gains pretty much across the board right now for the Dow, the Nasdaq, and the S&P 500. Shauna?
We are. We're moving higher here. You got the Dow up another 0.5 percentage point here, adding to gains right at the open. You can see pushing further above the 40,000 level. You've also got the S&P 500 moving to the upside now, getting closer to 5,700. Flipping back over to the Nasdaq Composite as it calibrates here. We're still looking at gains there at the open. On a sector basis, we are looking at much of the green on your screen. You can see healthcare, consumer discretionary really leading today's action. On the flip side, you do have energy and materials under a bit of pressure. But again, this rotation that we have been talking about within the market, you could note that actually, where'd it go here? Technology right, not too far from the flat line there. So just below the flat line as that rotation seems to be taken, I guess, really underway. Wall Street.
We're starting. Things are starting up. We're revving up.
All right, let's get over to Jared Blickery. He's got a look at some of the movement that we're seeing here at the open. Jared.
Yes, I am watching the Dow at another record intraday high. We've had a few of these recently, and let me put the Dow on there. This is a 4-year chart. I'm going to switch it over to year to date, and you can see how we just only yesterday started climbing into record territory once again. It had been a while. You can see that we did it in May and in March. But what's interesting about this bull market, and in fact, this is how most bull market evolves, you have different strengths, you have different sectors showing strength at different times, and you see sector rotation. That is the lifeblood of the bull market, and you take a look at what's happening in small caps. I'm going to put a 4-year chart on here so you can see how long small caps have been stuck under the 2100 area. This is the Russell 2000, by the way, and only a couple days ago have we broken free. And then you can take a look at the S&P 500 equal weight. That has been perking up as well. And it's just been interesting to track some of the laggard sectors that have really just shown some strength. And this goes back, a lot of these streaks have been going on for 4 or 5 days, but it was 3 trading days ago on Thursday that we got that CPI print really changed the game. So today leading the sectors is consumer discretionary. That's up 0.9%, followed by healthcare, energy trading to the downside. But I want to focus on some leaders here. First, we got Homebuilders. Those have been showing a lot of strength recently. They just broke to a record high, and that happened only 2 days ago. We can also take a look at biotech. That is showing some strength. This is a 4-year chart, so it's just emerging. That looks a lot like the small cap chart. And then we can also look at regional banks. Those have been perking up recently. We are just a little bit away from the first 52-week high that we've seen in years, and this comes after all the damage that had to be repaired from these charts from that failure that we saw last March. So all in all, a lot of other sectors and industries just perking up right now.
All right, Jared, thanks so much for breaking that down for us. Well, stocks are opening here to the upside. You've got gains across the screen. You've got the Dow up nearly 200 points on the move to the upside coming after retail sales coming in flat for the month of June. It was actually exceeding expectations and breaking a streak of disappointing reports. You've also got May revised upwards here, so maybe pointing to the fact that the consumer is in better shape than maybe initially anticipated. For more on this, we want to bring in Matt Maley. He's Miller Tabak's Managing Director and Equity Strategist. And Matt, it's great to see you. So let's just take a step back, because when we take a look at these econ data reports, a lot of times we're looking at the market's reaction, and when they are better than expected, we're actually seeing maybe some pressure in the equity markets. That doesn't seem to be the case today. What do you think is going on and really driving today's action?
Well, I mean, one of the things, of course, is that people have been starting to worry a little bit about the consumer and how strong the consumer is. So this number, I mean, it's funny because when interest rates go down, people say that's good, and frequently it is. But we don't want it to be a sign that the economy is slowing. It's one thing for interest rates to go down because inflation is coming down, but it's a whole nother thing if it's starting to show that we're headed towards a recession or even just a meaningful slowdown in economic growth. So I think that's why we're seeing a pickup today. But those numbers they're okay. They're not great. I mean, and you look at what happened with Bank of America this morning, talking about the net charge-offs have been increasing there. So it's still somewhat of a mixed signals we have here on the consumer.
And so if we're thinking about how this consumer could define not just the rest of this earnings period, but potentially the time period for companies leading up even into the fourth quarter, as we're thinking about what that holds, which is a general election where more consumers, and this has started to shift the consumer sentiment a little bit, what their projections are or what their optimism is around that particular event and how that may curtail their spending. How do you kind of game out what the trend of the consumer might look like going into and even in the latter portions of this year?
Well, I mean, one of the things that, needless to say, the consumer is so incredibly important, 70% of our economy. And, I hate to say it, but things have been kind of trending in the wrong direction, even though these numbers were pretty good today. I mean, we know all about how, high the credit card, the credit card debt is. But now, more recently, we're seeing the delinquency rates on that starting to pick up. We're seeing that also in auto loan delinquencies. Same with overall consumer debt delinquencies. So that's a big concern. But as you state with the whole thing with earnings, it's going to be really, really important that not only does these S&P companies or overall companies beat expectations. Let's face it, they always beat expectations, at least, well over 70% beat expectations every time. But what's their guidance going to be? Is it going to continue to move up? Because it really has to, because we're at a stock market trading at 23 times earnings. It's going to be tough if we don't see future earnings forecasts pick up to kind of bring that PE ratio down a little bit.
Matt, I'm curious just what you've made of the reaction that we've seen to the latest developments on the political spectrum when it comes to the jump that we did see in yields. Yields obviously reading a potential Trump presidency as the fact that maybe we will see an increase in spending. We're having more and more focus on the fiscal side of things in that debate. Has that movement been a bit surprising to you, and why?
Well, it has been. Now, it certainly has been the narrative over the last couple of weeks that if Trump were to win, that fiscal spending would pick up more. But, I think if we're honest with ourselves, we see that both parties haven't been particularly good on the fiscal side of things. I mean, they're spending money hand over fist. And so this is a concern for me, but I don't know if it's that much more of a concern if Donald Trump becomes president rather than Biden. And we also have to wonder, I must admit, Sunday we were, everybody was talking about on the political side of things that, Biden's going to be the nominee. We're not this, obviously what happened over the weekend was a tragedy on Saturday. But thankfully, somebody did lose their life, which I'm sorry to say. But my point is that the pundits last night, I was surfing around the political cable networks last night. A lot of the pundits are really starting to worry about Biden very quickly. So we could see a lot of uncertainty still in that marketplace coming to on the political side of things.
All right, Matt Maley, who is the Miller Tabak Managing Director and Equity Strategist. Matt, thanks so much for taking some time here just after the bell this morning.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. You're watching the Morning Brief, brought to you by Invesco. Morgan Stanley and Bank of America closing out their earnings for the big banks here. Stocks moving in opposite directions right now. Bank of America reporting second quarter profit that fell nearly 7% from the year prior. However, they topped expectations for the second quarter and report a slight beat on net interest income here. Now, Morgan Stanley, we should focus in on that as well. That also beat on the top and bottom line, but the company's big wealth management division missing on revenue. Let's bring in Stephen Biggar, who is the Argus Research Director of Financial Services Research. Great to have you here with us. You have Morgan Stanley listed as one of your top picks. Take us into your analysis from the earnings that came out this morning and perhaps what that spells out about the broader banking sector right now in the earnings season.
Yeah, good morning. So, right, a little bit light on the wealth management side for Morgan Stanley today. Certainly offset by a terrific performance by investment banking. Revenue's up 51% there. So that's been kind of the story broadly with banks and what we expect to going into the quarter, that we'd have a much better backdrop and environment for investment banking. We've seen gains from as low as 20% from Goldman Sachs to over 70% for Citigroup and everything in between. So I think that's the narrative that we expected. The lending business and deposits have certainly gotten more costly for the banks at large. I mean, you think of them a little bit more in terms of the regional bank side, but certainly the large global banks have some deposit pressures as well. Fortunately, more of the pure plays like Goldman and Morgan Stanley, the investment banking side, the fee revenues much more dominate than the net interest income side. So I think the narrative going forward is going to be something similar. If you like these banks, as I do, for the improvement in the capital market side and not so much the lending business or specifically wealth management.
Even if we do see the Fed wait to cut rates, I guess in terms of that turnaround or some of the strength that maybe you are expecting to see here in the coming quarters, is that going to delay that? And I guess by how much?
Well, I think the higher interest rates or the higher for longer that we've had have been not good for banks. They've kind of worn out their welcome at this point. So I think lower rates would be a benefit for banks, both on the loan growth side. Loan growth has been very anemic as high interest rates have curbed loan demand, and also taking some pressure off those deposit costs. So I think that's why banks are, while they're very well hedged to whether rates go up or down, I think at this point rates would still be high enough. We're not expecting rates to fall off a cliff. So in the back half of the year, if we do get 2 interest rate cuts as we continue to see, I think the lending business will actually pick up relative to where it was in the first half.
Which bank is worst positioned right now from your perspective to really navigate this macro environment?
Well, we have a preponderance of buys across the board, and that would include Wells Fargo, who I would admit has had the weakest results of any of the banks we've talked about so far: J.P. Morgan, Citi, Goldman, Bank of America, and Morgan Stanley. But Wells, in addition to the regulatory continued issues there with in terms of the asset cap, they are still kind of working their way out of that. They guided down on net interest income. Certainly among the large players, Wells has more of a dominance from the lending business, less so on the fee-based business. So that's just a little bit more difficult environment to be in. So while we like the group broadly, I think it's really the global banks that are going to have the better time here.
The what bank? Sorry.
Sorry?
Can you just repeat that last line that you said there? Who's going to have the better time?
Well, no, I think the global banks, so the J.P. Morgan, Citi, Goldman, Morgan Stanley, Bank of America have a better opportunity for revenue growth in this environment than a Wells Fargo.
Stephen, more specifically on Morgan Stanley, because that's where we are seeing the big reaction here this morning. Yes, there was a lot of key data points within this report or key metrics that investors are encouraged about, but there really has been this focus on some of the weakness that we are seeing within wealth management, just in terms of not living up to expectations. Is that something that your confident CEO Ted Pick is going to be able to expand in terms of having to gain even more market share within wealth management, or is this an area which could prove to be a bit challenging here for the bank in the coming quarters?
Well, I feel they have a very strong wealth management franchise, but having said that, they have faced some pressure, and there's a lot of competition, particularly for the high and ultra high net worth segment within wealth management. So I think that's where some of this is coming from, as well as this again, higher interest rates have pushed up deposit costs. So to the extent that they are not offering the best rates on deposits, there's some migration to other firms. So I think they. The conference call will shed some light on those. But again, I think a terrific wealth management franchise. They tend to have relatively good retention, but something was amiss this quarter, and we're going to have to dig into what that is.
Stephen Bigar, who is the Argus Research Director of Financial Services Research. Thanks so much for taking the time here this morning.
Thank you.
Coming up, Apple hitting another record high. What this means for its next iPhone cycle. That's on the other side of the break.
Welcome back to Morning Brief, brought to you by Invesco. Apple hitting another all-time high, bringing its market cap above $3.6 trillion, well ahead of the next closest company, which is Microsoft, which sits at just over $3.3 trillion. Now, the tech giant also seeing its India sales jump 33% in the 12 months through March. That's according to the latest results that we have out from Bloomberg as Apple looks to diversify beyond China. So what does this all signal ahead for the company's next iPhone release cycle? We want to bring in Gil Loria. He's D.A. Davidson's managing director. Gil, it's great to have you. So it seems like we have this unrelenting move to the upside here in Apple shares, and the narrative surrounding Apple certainly shifting here. Lots of excitement surrounding that new AI-enabled iPhone that we're expecting to be coming. I guess, do you think that a lot of this excitement, is it warranted?
It is. We haven't had a major iPhone upgrade cycle since iPhone 12. And now that there is a sense that there's enough new functionality and uses for the phone that we will have an upgrade cycle, which could last for a year or two, that warrants this excitement around the stock. Let's not forget, iPhone is half of Apple's revenue, and it really pulls with it a lot of other revenue, including services revenue, which has been the ongoing best grower within the business lines.
And so for Apple, what does this signal about some of their other product lines? What could continue to, or what could do well as the company looks to further penetrate the India market?
So India has a long-term promise for Apple. It's the country that's creating the most middle class and upper middle class population anywhere around the world by far. It is, in that sense, the kind of driver that China was for the last 20 or 30 years. And so that's why it's a critically important market. Now, to Apple's benefit, it doesn't have domestic competitors there. Unlike China, where now Apple is going head to head with the domestic competitors that are making better and better phones. In India, that's not the case. They really have as dominant a position in the high end of the market as they do in other countries outside of China. And that means that India will continue to be a long-term growth driver across businesses for Apple.
Gil, what do you think this upside really looks like here for the stock?
So in terms of the growth rates, the consensus expectations, at least going into the Worldwide Developer Conference, was that iPhone would grow 5%, which was actually not bad considering it hasn't grown in a couple of years. We actually think that iPhone sales this upcoming year could grow 10% because the functionality is going to be compelling. As folks use some of this new functionality during the holidays on their iPhone 15 Pro, and some new users use it on the iPhone 16 versions, it's going to be compelling to other people and other around them. And other people have iPhone 12s, 13s, phones that are due for an upgrade. And once they see that this functionality is only available in newer phones, it will compel them to go out and buy a new iPhone.
You also cover a host of other tech companies, one of them being Microsoft. Are there other strides that you're seeing other consumer tech companies make within the same region where Apple is starting to see its efforts really ramp up?
So on Microsoft's side, the impact is so broad right now in the implementation of more AI and generative AI, including in the PC category. So the AI PCs will be another place where we start using AI capabilities more, generative AI capabilities more. AI PCs have been for sale. They'll probably be part of a cycle as well. It may not be as pronounced as the iPhone cycle, but considering PC sales have been in a hangover the last couple of years, they've started showing signs of growth. And that's a category adjacent to the Apple, right? The Mac is going to have AI capabilities as well, and that could drive more sales there. So let's not forget that that's another category that Apple could benefit from, but Microsoft will as well. But for Microsoft, the benefits of AI are really across the business, starting with Azure, into the Office products, et cetera.
Gil, most of the Mag 7 companies are within your coverage. When investors hear about a broadening out or people perhaps reducing or trimming some of their positions, taking profits where necessary in some of these names, and then either sitting on cash waiting to deploy or reallocating to other sectors, what does that hold for these companies that had been part of the famed Mag 7, and should they be weary when they hear about that broadening?
We'll see. The biggest cap technology companies have outperformed because their fundamentals have outperformed. They've grown earnings when others have not. That's why that's most of the reason their stocks have done better. It's also the fact that they present less risk because their businesses are so entrenched and diversified. That would have to change. We would have to see the 492, 494, whatever other companies you want to consider actually have earnings growth. They haven't had earnings growth for a while. If they actually have accelerating earnings growth outside of these mega caps, we may see a convergence of stock performance. That just hasn't been the case so far. It is these biggest companies that have had the highest growth rates in revenue and profitability. They've contributed most of the growth to the S&P 500 earnings. And until that changes, we may not see a convergence.
And Gil, real quick before we let you go, if you had to pick one of the big tech names that's best positioned here ahead of this earnings season, who do you have?
Amazon. Microsoft and Apple are now getting a lot of credit for what we just talked about. They're seen as AI winners, and their stocks are reflecting that by trading at the high end of historical multiple ranges. We actually think Amazon at the end of the day may have more AI business than any of these other companies. AWS is the biggest hyperscaler, and it's done a lot to catch up to Azure in terms of AI capabilities. And yet Amazon is getting very little credit in terms of multiple. It's trading at average multiple compared to its historical rates. And so we think that's where, when they get more credit, that stock will outperform.
All right, Gil Luria, D.A. Davidson's Managing Director. Thanks as always for hopping on with us.
Thank you.
Coming up, is the market rally finally starting to broaden out? It is. I think the question is whether or not some of the movement that we have seen over the last couple of days, if that is going to continue. We will dive into that next on Catalyst. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Stocks moving to the upside here after a surprise for retail sales coming in flat rather than the forecast, which was a decline in those numbers. Now, this comes as Fed Chair Jay Powell adding to optimism around the path forward for rate cuts, saying on Monday that the FOMC has gained more confidence on inflation's path down to 2%.
And regional banks, PNC and Charles Schwab, out with their latest results this morning, raising some red flags in terms of the health of some of these regionals. Right now, Charles Schwab shares are selling off this morning, on track for their biggest drop since last year. We've got more on that coming up.
And former President Trump picking his running mate, Senator J.D. Vance. We'll dig into his record on business and the economy and how that could impact the broader Trump campaign.
All right, but first we have to talk about some of the rotation that we've been seeing play out in the market here over the last several trading days. Small caps outperforming the S&P 500 in the last week as investors are now starting to price in the high likelihood of a rate cut, 100% chance of a cut by September. That's according to the latest figures out from the CME Fed Watch tool. Our very own Josh Schaefer joining us now to talk about this. So Josh, we have seen the shift in terms of the optimism. We have seen small caps catching a bid here, but the question though is, does it really have some room to run at this point?
So we've done this before, right? I think that's the important way to start this conversation. We had this conversation in November and December of last year. We had this conversation in February and March. So yesterday I went out to some strategists and just said, what is different this time, if anything? And strategists do feel like this is a little bit different this time because quite simply we're closer to those cuts. We're talking about a September cut. It's the middle of July. So that's actually supposed to come pretty soon. It also comes at an interesting time for the fundamental story here. So we opened talking about small caps, but I want to talk a little bit about just sector rotation within the S&P 500. We're supposed to see the earnings recession end for the 493, which takes out our Mag 7, the big tech companies. That's supposed to end. We're supposed to see earnings growth for the first time in about 6 quarters for the 493 right now in this reporting period. So they feel like there's sort of a fundamental backing here. And then from this quarter on, you're supposed to see earnings continue to pick up for that 493 while they fall for your Mag 7. Rising earnings would normally be kind of the strong fundamental story, right? So if you get that, that's key. Where people are sort of more cautious is we're talking about estimates, right? And last quarter, if you remember, Mag 7 was supposed to have a little bit of a decline and it didn't really have a decline, right? So that's estimates. It might not happen. And that's kind of the other side of this with the Fed rate cut. So the Fed rate cut is where people like to talk more about small caps. Small caps are more of the play once the rate cut actually happens, not necessarily leading into it all the time. So people aren't fully saying right now is the time to dive into small caps. It seems like they're more positive on that post rate cut. And then the larger question there being, why do we get the rate cut? How many cuts are we actually going to see this year? And so it seems like the pause is probably more on the Russell 2000 than it is on the sector action that we've seen within the S&P 500. There aren't a ton of strategists right now that are super, super bullish on just diving into small caps. I don't think that, even though we've seen that come up a decent amount over the last couple of days, that doesn't seem to be really the widespread call.
What's the biggest driver of the broadening in those 493? Is it rate cuts or something else?
I feel like right now it seems like it's a little bit of rate cuts, right? At least that is kind of the broad sentiment. You've seen the shift since that inflation print, right? I don't think it's ironic that this all started happening last Thursday after a better than expected June CPI. So if we look at just when the movement started, that sort of gave you your go, and then you see kind of what happened from there, I guess, and it'll be interesting to see. We're looking at 100% priced in for September this morning. We know those odds basically shift every day. Yeah. And so if it does scale back, what does that do to kind of the rally that we've seen? And will people step back out, I think is perhaps maybe the most interesting part of this. Mm-hmm. And then also, we still have big tech earnings to come. And just because people want to buy other areas of the market doesn't mean that those companies doing well kind of brings people out of big tech either, right? There's sort of this discussion right now, I think, of, well, people are rotating out of big tech into these other sectors. It doesn't mean that big tech still can't work too. And I think when that fundamental story from big tech comes out with the earnings, you're going to see sort of where the chips lie with that.
All right, thank you so much, Josh. Really appreciate you joining us on that this morning. We're going to continue to take a look at markets here. You're looking at the three major averages right now. The Dow and the S&P on the move to the upside, but you're looking at some pressure in the Nasdaq, down just about 0.2% here. Now, this comes after this morning. We had some additional results from some of the big banks, also some regionals, and we got that retail sales print coming in softer, actually above expectations. And this comes as earnings seasons is continuing to chug along. So where will that leave the rotation question we were just chatting about? Joining us now to discuss, we've got Jose Rasco, HSBC America's CIO. Thank you so much for joining us in studio, Jose. So we were just talking about this idea that the 493, the forgotten 493, are finally having their moment to shine. Do you see that becoming a reality this earnings cycle?
Yeah, I think there's two components to that. Number one is cyclical, right? So you're going to see a slowing in the economy, and the stock market in general is going to struggle with that, right? You're going to see earnings struggle and all that cyclically. But what can save the day? What can save the day is that margins look pretty good, right? Number one. Number two, the Fed is expected to cut rates. So from a cyclical perspective, that's a bonus. From a secular perspective, the tech revolution is just beginning. We're talking about AI, and we're talking about the deployment of AI in technology companies still. It still has not hit that second and third leg of this, what is typically a long revolution in any technology. As that gets deployed, productivity improves, costs go down, profits go up. So we think that broadening out of the market is coming. Fed rate cuts will be one trigger, but that's probably going to be priced in.
Yeah, Jose, what do you think the timeline looks like for that, just in terms of what exactly is going to be the catalyst? And when we have this massive gap between the outperformers or the handful of winners and really underneath the surface, when you take a look at a lot of challenging times right now for a number of companies, is that it's not going to be a quick fix, right? Like, this is something that's going to take maybe months here to correct if we are going to see more of that inline performance across the board.
Well, so growth has outperformed value by 4x, right? So year to date, it's been a monstrous outperformance. Thank God we've been on the right side of it. But I think you're going to see some catch-up. Valuations just are compelling in certain areas, and I think that's going to play out over the next month or two before we get to the Fed rate cut. Remember, September is the end of the fiscal year for the federal government. God knows what's going to happen in terms of treasury issuance, right? And that could push rates back up, as we've seen 2 times already in the last year. And that could have an effect on the market short term. Longer term, however, fundamentals still look good. And again, I hate to sound like a broken record, but those 4 underlying themes continue to push growth and inflows of capital into the U.S. upward, which is good for equities.
So if we're hearing all this good news from you about growth for equities, then why rush to worry about a rate cut? I mean, we're heading towards the S&P having its longest stretch of not having declines of 2% since the global financial crisis. Why mess with it?
Yeah, from the Fed perspective?
Yeah.
Well, because they look at the economy, not just the stock market, right? So I think you're going to continue to see a lot of byplay between the Fed governors talking about not cutting rates and cutting rates over the next, especially as we get through Jackson Hole. You know, it's more of a theoretical conversation. I think they're going to focus on a lot of that to try to keep the market from melting up further and therefore potentially stoking some inflationary fires as the consumer feels richer, is richer, and spends the money. They want to avoid that, right? So they want to have this be a gradual increase. And I think historically, when the Fed cuts rates, it's accretive to earnings and it is very positive for the market. So we want that to be built in over time.
Jose, do you think the market's getting a little bit ahead of itself just in terms of what it's already pricing in, what the Fed is going to do here in terms of cutting rates at the September meeting? Is that too optimistic at all?
No, I don't. We don't. We've said September all along. We feel we're pretty comfortable with that, and I think the data have slowed sufficiently to warrant a Fed move. Right? Remember, it's not just about the headline data. It's about what's happening underneath the data. And we're seeing pockets of weakness in some of the consumer areas, right? Even though consumer spending looks pretty good for Q2, based on this morning's data, right? The control group was up almost 1% in 1 month, right? That's pretty good. So I think the consumer, though, is slowing. We're seeing that trade down from steak to hamburger already take place. And you're seeing, more importantly, the retailers are responding. They're cutting prices, right? So you're seeing it across in products and services. That said, I think it's important to remember that the Fed is not focused on 2024. They are focused on their own calendar, which is the easing cycle, which they already told us is going to take 2.5 years.
So real quick, does that mean that you think that the Fed is more important than the election in terms of the market impact?
Yes. Yes.
Okay.
The election is important, But remember, we're up almost every year except 2000 and 2008. U.S. stocks are up and they outperform by almost 5%. So elections are important. The Fed is more important because it lowers the cost of money. So.
All right, Jose Rasco, always great to have you, especially here in the studio. Thanks so much for joining us today.
Thank you both.
All right, former President Donald Trump picking his vice president, Ohio Senator and former venture capitalist J.D. Vance. Wall Street already beginning to weigh in, with Cowen analyst John Miller predicting that the VP nominee is going to focus his campaigning on industrial policy and anti-China trade proposals. Here to discuss this, Kim Wallace, he's 22V Research Senior Managing Director. Kim, we were just talking about with Jose Rasco here in our last segment, what matters more for the market, the election or the Fed. He's saying the Fed, but when it comes to the election, now that former President Donald Trump does have a VP pick, what do investors need to keep in mind just in terms of what exactly J.D. Vance could signal here for investors were Trump to be elected in November?
I think Jose nailed it, but to answer your question, what it signals is consolidation of MAGA power within the GOP. If this ticket is elected, the question of whether or not traditional conservative Republicans would eke out space for themselves is over. In the sense of the national campaign, it could become competitive again, but public sentiment, the preponderance of public sentiment indicates it won't be competitive with President Biden at the top of the Democrats' ticket.
I want to zero in on the J.D. Vance of it all and what we saw at the RNC yesterday. The Teamsters ahead kind of really being clearly anti-big business. We have reports that when he talked about corruption and big corporations, there was kind of this tepid silence over the room here. In terms of the J.D. Vance of it all, is he pro-business?
I think Senator Vance's positions on free market trade are malleable, and that's demonstrated in change in some wholesale political and policy positions in the last 3 years from the person he was, at least in politics and in business, the decade before that. So I can understand why the convention hall may have been a bit confused, but again, I don't think many of the delegates in Milwaukee are concerned about who will run policy if Trump is reelected to the White House. J.D. Vance will be at the table, I would assume, but certainly it'll be President Trump deciding what policy is.
Kim, I want to ask you about the big, deep-pocketed donors. We have Elon Musk. There's a report out from Wall Street Journal saying that he's going to donate to a pro-Trump campaign or a PAC that's helping to get Trump reelected here. $45 million per month in donations. Do you see this significantly swaying the election? And our columnist Rick Newman making the argument that, hey, maybe this could actually favor Biden in the long run because it shows maybe this disconnect between Main Street and Wall Street. What do you think?
I think it's possible, but first you have to get back to a competitive footing on the campaign. That's job number one, so that voters are not focused on the downside of reelecting the Biden-Harris campaign, as clearly is sentiment in all of the major polls, the preponderance of that evidence anyway. In terms of the billionaires rallying behind the former President Trump, that's voting with your dollars. That's part of democracy, and certainly part of democracy since Supreme Court decisions going back to 2010 and 2014. For Democrats, they have donors that make this race competitive. You've heard some of those donors pull back, concerned about the viability of the ticket as it stands now. So I don't think money in U.S. politics is ever going to be a determinative factor, simply because there's way too much, there are many avenues for money to find its way into U.S. politics. The question is, does it sway, in my view, does it sway the policy agenda favored by the billionaires? And it's not just Musk, it's a long list of billionaires in the last 2 months who have profess their fealty to the former president. I would say that in the NPR PBS News Marist poll from Friday, I was struck by the fact the gap between people earning $50,000 or less, 24% saying they're going to vote, versus those earning more than that mark, 76%, speaks to the bifurcation of the economy and probably the opportunity that some of these billionaires see in coalescing around former President Trump early or relatively early in the process.
Do you think, Kim, that there is a policy that Biden could talk about within the campaign cycle that would garner more support from that higher income group that you just mentioned is more likely, according to one specific poll, to be voting come November?
Not so much what I think. We look at data here at 22V, and all of the data suggests that getting into the weeds of contrasting, and it's a broad contrast between President Biden and former President Trump on almost all policies outside of trade and one could say loose fiscal policy. But the difference between these men is stark. You can't get to those details. You can't motivate a base about that so long as they have the top-down view of the viability of the ticket.
Right. I guess, Kim, to be more specific, for example, yesterday we had Biden talking about proposing capping national rent increases at 5%. Is that type of policy something that is going to help him get back into the White House in November?
I would think not, in part because the proposal appeals to a slice of America and certainly a slice of the party. But again, and not to harp on it, but to talk about the plain facts, a proposal that could become policy in the event of an election outcome is highly unlikely to change the view of most respondents to public polls, and more importantly, the Democratic base up and down the ticket in the various states and districts and among donors. That's the first challenge for Democrats, is to find a way to reverse the momentum that former President Trump has enjoyed nearly all of the last 3 weeks, and the ennui, if you will, if not despondency, that has permeated many Democrats in that period.
All right, Kim Wallace, 22V Research Senior Managing Director. Thanks so much for joining us here. Let's do a quick check of the markets. Just about 47 minutes into the trading day, we're looking at a mixed picture. You've got the Dow and the S&P holding on to gains right now. You got a bit of a rally going on in the Dow, with the Dow up just over 1%. On the flip side, some weakness in the Nasdaq. The Nasdaq starting the trading day in the red here, off just about 0.3%. Coming up, we're diving into some of today's trending tickers. We got to look at Tesla, Dollar Tree, and Reddit. That's coming up next on Catalysts.
Let's take a look at some trending tickers. Taking a look at Tesla shares down over 1%, nearing downside moves of 1.5% here. Now, this comes after last week's robo-taxi disappointment, and Elon Musk also saying that there's going to be delays to the robo-taxis because he's focusing on a redesign effort. Now, this also comes as Elon Musk talking about other things, of course, voicing his support for former President Donald Trump in the election and talking about donations to former President Donald Trump's campaign as well. Now, there are questions about whether this is significant for Tesla because in the recent past, Trump has been critical of electric vehicles. So how does this endorsement impact the EV maker moving forward? I do also want to push this forward, though, to Tesla's earnings coming up. Taking a look at some data in the options market, looking at an implied move of over 8% following Tesla earnings. That is obviously a huge move. In 5 of the 8 past earnings for Tesla, the company's stock price has moved more after the announcement than even the implied options move. So you could be looking at a move of over 8% given that historic view on the stock, but certainly a lot to think about when it comes to, of course, the fundamentals of the company with the robo-taxi announcement, Shauna, and then CEO Elon Musk's political moves as well, adding to the broader Tesla picture here.
Yeah, and JD Vance, the VP pick here for Trump, has been very critical of EVs in the past. So that also raises some questions too as to exactly what maybe a Trump presidency could look like here for Tesla. And we put this question to a number of analysts over the last several weeks. And analysts seem to be split. You have Dan Ives on one side from Wedbush saying that, hey, a Trump presidency is actually good news for Tesla, how they're positioned, their cash balance, their strong balance sheet, their cash position really giving them a leg up were former President Trump to be reelected here in November. On the flip side, we have heard some others be a bit more cautious just in terms of maybe the pressure that we could see almost across the board, and not just Tesla, but really across the board when it comes to EV makers or automakers that have made a bigger push into EVs, including those traditional automakers, legacy automakers, that they could come under a bit of pressure. We asked Guggenheim's Ron Iacocca about this last week, and he's had this to say about the implications of a Trump presidency and what exactly that means for Tesla. Let's take a listen.
We really struggle to see this as a benefit to the extent Trump's elected. You mentioned the $7,500 credits at risk, which is a key affordability enabler for Tesla vehicles. Also, the Chinese batteries potentially seeing higher tariffs. Tesla's lowest price models in the US do use Chinese source batteries, as do other manufacturers. Tesla's not unique there. And at the end of the day, this was a rising tide lifts all boats scenario. I think the analog to that to the downside is a receding tide. It doesn't necessarily sink Tesla's ship, but it does sink some ships, and it's certainly negative for everyone.
So sink some ships. There's some talk about the exact pressure that maybe could place here on names like Rivian and Lucid that are under just a bit of pressure. But again, overall, it seems like more of the consensus is the fact that it's going to place pressure on the EV makers. A bit of a split, though, as to exactly what this means here for Tesla going forward, given their leadership position. Let's take a look at Dollar Tree getting a bearish call from Piper Sandler, the firm downgrading the stock to neutral from overweight, slashing the price target on the stock to $112 a share, saying that the company is, quote, uniquely disadvantaged regardless of the outcome of the presidential election. And they went on to cite a number of risks. The analyst there, Peter Keith, lowering his rating to neutral from overweight, saying that the turnaround after the introduction of the new management 2 years ago doesn't seem to be working well. When it comes to exactly how the election is going to play into this, the analyst there, Maddie, at least making the argument that Trump's tariff policies are likely going to put some pressure on profit margins here going forward.
Yeah, it points to this broader conversation about which candidate is going to be better for business. And this is the question that we have consistently been posing to guests throughout this morning here. This argument from the Trump camp that tariffs are going to be a positive catalyst for business. This is one example of a very specific idiosyncratic company that this analyst at least thinks will not be benefiting from those tariff policies. The idea from the Trump camp is that if we put tariffs on Chinese goods, that's going to be a boon for U.S. businesses. Not so much when you're thinking about a company that really relies on goods that are made, frankly, very cheaply, and therefore you're able to sell them cheaply to a very very specific consumer. Having said that, on the other side of the coin, Peter Keith saying that Biden's policies also pose a risk because Biden could be pushing for increased wages for Dollar Tree staff. That could, of course, also weigh on profit margins. So I think it really is a great example of this broader conversation we've been having about which camp is the pro-business camp, which is only furthered by the discussion about J.D. Vance and where his business policies lie in the broader election space, too. Well, Reddit shares are also under pressure after a downgrade at Loop Capital based purely on valuation after the stock's recent run to all-time highs. Our very own Inez Ferreira is standing by with more. Inez.
Yeah, Madison, and Reddit's downgrade from Loop Capital comes on the heels of recent gains for shares of the social media platform. The stock reached all-time highs on Monday before giving up some of those gains. Now, Loop Capital analyst Alan Gould put a hold on the stock with a $75 price target. The analyst stated the stock is now trading at well over twice its March IPO price, a significant premium revenue multiple to its peers, and will likely be selling pressure when the lockup period expires on August 9th. Meanwhile, JP Morgan analysts raised their price target on the stock to $67 from $57, given the OpenAI licensing deal, which was announced back in May. However, JP Morgan still has a neutral on the stock, noting also that lockup period that we just mentioned, the expiration in August. Separately, you have JMP Securities, which raised its price target on the stock to $84 from $70 and called Reddit a top pick given the engagement momentum, improved advertising tools, and growing data sales business. Now, the company is expected to announce its quarterly results on August 6th. And if you just take a look at the stock since the start of May is up more than 55%. Now, remember, Reddit priced its IPO back in March at $34 per share when it went public. On its first day of trading, it reached a peak of $57 per share. Now it's trading below that $70 level, around $68, guys.
All right, Inez, thanks so much for breaking that down for us. Coming up here, we've got June retail sales. They did come in flat, but that was better than anticipated. So we will discuss what that could mean for markets and the broader economy moving forward. That's next.
Retail sales coming in flat this month, which is better than expected. And when you take a look at that retail print, we are seeing some of that reaction play out in the treasury market. You got yields under a bit of pressure, pulling back following the gains that we've seen in the last couple of sessions. Joining us now for what's ahead for the bond market, we want to bring in Michael Contopoulos. He is Richard Bernstein's advisor's director of fixed income. It's great to see you. So let's just take a step back, because we certainly have seen interesting, lack of a better word, action play out within the bond market, and reacting to the political developments. It's also reacting to the latest econ data that we've gotten out over the last several trading days. I'm curious just your thoughts on the current levels here of where we are trading, and maybe what that signals for increased volatility that investors should be bracing here for the weeks and months ahead. Michael, I don't believe we have your audio. Do we have it, guys? Control room? All right, Michael, we're having some difficulty here with your audio, so we're going to try and get that worked out and come back on the other side. Stick with us. We'll be right back. Retail sales coming in flat for the month of June. The better than expected retail sales print moving the bond market this morning. Yields pulling back just a bit. Joining us now on the catalyst here for fixed income going forward, we want to bring in Michael Contopoulos. He is Richard Bernstein Advisors, Director of Fixed Income. Michael, it's great to see you. So let's first start with the reaction that we're seeing play out on the heels of the retail sales print this morning. Yields had been under more pressure. We did see them paring back some of those earlier losses. I'm curious what you make of this morning's reaction so far.
Yeah, I'm actually a little bit surprised that yields are coming down a bit here. I mean, the retail sales data was actually, quite strong. And I think, we've seen in general so far in 2024 that data has surprised to the upside. I mean, certainly you've had some moderation in economic data as of late, but today's retail sales doesn't suggest that the consumer is falling off a cliff. It doesn't suggest that the modest rise in the unemployment rate is really a huge concern. And that, the consumer is still strong and spending quite a bit. So I'm a little bit surprised that the long end of the yield curve is down a bit. But, I've also come to realize over the last several years not to make a big deal out of, a few basis points move in either direction.
So what do you think is the biggest driver, though, of the moves that we're seeing on the long end of the curve? And is it something that investors can brush off the way that you kind of are, or is it something that potentially is going on under the hood that investors need to be paying attention to?
Well, I think right now we're very much in a range-bound market, pretty much across the curve until you have something happen at the Fed, right? If the Fed cuts in September, which of course the market is now pricing in, then I think you're going to continue to get the yield curve steepening that we've seen over the last several weeks. If the Fed doesn't cut in September, then I think you can kind of bounce around, in the range that we've been in. And listen, we've been living very much in a range for the last, 4 or 5 months. On the 10-year, I think that's going to be between 4% and 4.75%. And the daily data is going to move that on the margins for sure. But again, until you get the big event, which is of course the Fed's decision and what they end up doing, I think in September, I wouldn't expect major moves in the bond market, between now and then.
Michael, I'm curious from your perspective, though, are investors still a bit too complacent given some of that range-bound activity that we have seen? And I guess, what does that then signal just in terms of maybe the risk that could point to here in the coming months?
Because I think there are a lot of risks out there at the moment. One is complacency that we are, really have engineered the soft landing scenario. If you look at container ship prices, for example, if you look at both candidates, I know there was a big discussion earlier about former President Donald Trump, and if he's elected, is he good or bad for business? The one thing is very clear, regardless of who is in office, you're going to probably have inflationary policies, whether that be because of additional fiscal spending on infrastructure and things of that nature, whether it be because of tariffs and tax cuts. And so I think there's an underappreciation for the risks that inflation maybe doesn't trend towards 2% quite as quickly as the market seems to think it will. And that could end up happening at the same time as the Fed wants to get in a cut or two. And so, when I think about, regardless of the political environment, either candidate, how they end up in office, I think the risks are to higher inflation rather than low inflation. I think the risks are to a steeper yield curve rather than a flatter yield curve. And I'm not entirely sure the market has woken up to that quite yet.
So if both candidates are inflationary, what does that mean for the Fed come 2025?
Well, I'm glad you asked come 2025, because I do think there will be an intermediate step where the Fed likely, wants to get in a cut and will get in 1 or 2 cuts this year, thinking that they have, in fact, slayed the inflation dragon. And what that ultimately may prove is that it was a mistake as you get into 2025. Now, I think it's certainly premature to say that they will have to tighten policy again, that they'll have to raise rates again. But is it a possibility that the market is not really considering? I certainly think it is, that you could see a late 70s, early 80s type of mistake where the Fed prematurely cuts and declares victory, only to have inflationary policies really sort of bite them later. And so it wouldn't surprise me if the Fed doesn't cut as much in 2025 as the market expects, unless you do get sort of the recessionary growth slowdown that I think no one is really expecting at the moment, but is always sort of a possibility waiting in the ether.
All right, Michael, thank you so much for joining us. Really appreciate you sticking with us there. That was Michael Contopoulos. He's Richard Bernstein Advisors Director of Fixed Income. Now, coming up here as earnings from the big banks start to wrap up, we are getting results in from the regional banks. Up first this morning, we had PNC and Charles Schwab. PNC beating on net interest income and revenue, but seeing deposits declining. You're seeing PNC shares moving to the upside now, up just about 3.8%. Meantime, Charles Schwab reporting declines in new brokerage accounts. That put a lot of pressure on shares. We're seeing them down over 6.5% right now. So what does this signal about broader pressures in the sector? Joining us to discuss, we've got Christopher Marinac, Janney Montgomery Scott, Director of Research. We also have Brennan Hawken, UBS U.S. Brokers and Asset Managers Analyst. Guys, thank you both so much for joining us here. Chris, I want to start with you on the broader regional banking space, just taking a step back here. We have the KRE Regional Banking ETF up heading into today, for example. Do you think there's a signal under the hood of strength in the regional banking sector, or is it just ignorance of any kind of challenges that might still be lurking within the regional banks?
I think it's definitely strength. I think that there is a belief that credit quality is not as bad as feared. I think the deposits have been stable in the industry. Deposit costs seem to be slowing down their ascent. I think we're at a point where deposit costs are going to peak and back off ever so slightly the next few quarters, pending whatever the Fed decides to do. I think overall the banks are making money, and the capital retention has been very strong so far. You've seen tangible book grow over 2% at many of these large banks, which I think is very healthy.
Brennan, let's talk about the reaction that we're seeing play out in Charles Schwab, because that's the top trending ticker here in Yahoo Finance today. We're looking at a pretty significant move here to the downside, and the company really vowing to shrink itself here over time. I'm curious what you make of this report, the plans going forward, and ultimately whether or not the 7% move to the downside, if that's justified.
Yeah, I would say that they reported earnings this morning, right? They hosted the earnings call. In the earnings call, and from the report, we learned that wholesale funding, which they had been reducing, this is high cost funding that they're using to replace the sweep deposits that are yield seeking into money funds. What we saw was, after 2 quarters of progress, we saw that reverse. And so I think what we're seeing here today is some disappointment around the balance sheet trends. They also flagged on their earnings call that they would be shifting the strategy around the balance sheet, that they would be managing the bank subsidiary to become smaller and use third-party banks as a place in which to place deposits going forward. This would be a not revolutionary change, but an evolutionary one that will take several years. So to me, the reaction is much more about the balance sheet trends that we saw in the second quarter, confidence in the ability for them to continue to make progress in paying down that expensive wholesale funding going into the end of the year and through much of 2025, which is currently the baseline assumption, rather than the shrinking of the bank and making that a lot smaller.
And Christopher, going back to you here, I do want to focus on how some potential policies coming from potential White House attendees come November could be impacting this sector. Taking a look at KRE, as I mentioned earlier, it's up a whopping 13% over the past 5 days, and certainly up on the moving to the upside this morning here. JD Vance, obviously speaking with and working with Elizabeth Warren in the past, she even saying that he was great to work with when it came to regulation around some of the big banks. And he said that community lenders should be operating under different regulation than some of the big banks. Is that something that investors who do see a Trump White House come November should already start to position around any potential relief to the regionals?
Oh, absolutely. I mean, I think the angst on regulatory changes to the negative has peaked. And I think from here it's going to reverse. And whether it fully reverses with the White House, we don't know yet. But certainly I think the attitude is that the small and mid-sized banks should have a different playing field. They really should not have the same cram down that the largest banks are feeling, whether it's on capital, liquidity, or any other type of individual policies. I think the reversal of the angst is really what's happening. The marketplace is recognizing that the banks people were too negative. Now they can reverse that. The banks are still profitable. Credit is very much contained in terms of the risks, and the companies continue to move forward. We're not seeing a lot of growth in loans this quarter, but we are seeing companies being productive with what they have on the income statement, managing through both credit and spread. And we think both can get better the second half of the year.
Brennan, what do you think? Do you agree?
I mean, I don't cover regional banks, so I really don't have a view on regional banks. But what I would say is that when we think about potential changes around the Trump trade, which is, I think, probably the centerpiece of the question, capital markets were already in the beginning of recovery. And when we began to see the increased likelihood that the administration would go that way, last time that administration was far more conducive to capital markets activity recovering. And so really that narrative only strengthened.
All right, we're going to have to leave it there. Thank you both so much for joining us this morning. We had Christopher Marinac, Janney Montgomery Scott, Director of Research, and of course, Brennan Hawken, UBS U.S. Brokers and Asset Managers Analyst. Now coming up, how is slowing growth in China impacting domestic retailers? We're going to dive into that next on Catalysts.
Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line long after the presidential polls have closed.
Our bottom line, it's still the economy, people.
We've got team coverage from New York to Los Angeles, but we start right here in Washington, D.C.
You can catch Capital Gains on all your favorite podcast and streaming platforms. You can't afford to miss it.
Retailers like Nike, Lululemon, and Starbucks under pressure as slowing growth in China has weighed on those companies' profit margins. Now, as we head into the thick of earnings season, which names are best positioned to overcome some of that weakness? Joining us now to discuss, we've got John Kernan, TD Cowen, Managing Director of Retail and Consumer Brands. Thanks so much for joining us here, John. I want to start specifically on Nike having a really tough go of it with the consumer weakness that we've seen in China in particular. If you believe that the China story is not changing, how do you believe that there's going to be a recovery in Nike?
Well, we're very cautious on Nike. We have a hold rating and $75 price target, so there could easily be more downside in the stock from here. I think as you look at their China business, they've carved out a leading position in terms of brand preference in athletic footwear and apparel in China. The macro in China is a real issue. Our survey, which was a survey of 2,000 consumers on the ground in China, pointed to real concerns about some of housing prices. They're concerned the demographics in China are some of the worst in the developed world. And Nike has a tough go of it in China from the local-based China competition. Local-based China competition is increasingly scaling. They've added $5 billion in revenue since 2019 between two companies, Li Ning and ANTA. Nike's revenue is down over $1 billion during that time period. So Nike's in a tough spot from a macro perspective right now.
So how big of a drag do you expect that to continue to be on the stock?
I think investors and analysts need to rein in their expectations for China, both on a top line and margin basis long term. There's a lot of policy headwinds that could happen from here that are unpredictable and unknown. But if our Washington research group is right on some of their concerns about some of the trade policy, you could see a real retaliation from Beijing that could really hurt from a tariff perspective. It could hurt from a demand perspective. That's what we're most concerned on.
Say more about that retaliation. And do you think that retaliation requires a Trump presidency, or do you think that it is going to occur regardless of who ends up in the White House come November?
Seems like a bipartisan issue at this point, although Trump may bring increased rhetoric to the table, but permanent normal trade relations could be removed with China. They would certainly invoke some type of retaliation from Beijing. There's a lot of capital controls that our Washington research group has written and talked about quite a bit. And the retaliation from Beijing and Chinese consumers could be significant. Again, it's an unknown, but it certainly seems like it has higher probability of policy headwinds increasing as we get into 2025.
John, is that a similar argument just in terms of the downside risk that you're making here for Nike? Could you make that for Lululemon, and why or why not?
Well, we're buy rated on Lululemon. I think the stock's valuation is extremely cheap here, but I think one of the real concerns across our report today was how investors would value China-based cash flows. What's the appropriate discount rate? What's the long-term growth rate of companies' businesses in China? There's just so much uncertainty on this right now. Lululemon has an increasing percentage of growth coming from China. They're hosting Investor Day in China in October. So they are strategically very focused on China. And I think it's a concern from a lot of investors given all the issues we just spoke of.
What do you think the potential is for Lululemon to be able to emerge as the retailer that found a way to win in China when you've got Nike, Adidas, Estee Lauder struggling because of pressures in the mainland?
Yeah, sure. Lululemon's business right now is incredibly strong in China. We expect the China-based business to be up nearly 40% year over year this year, on top of very strong growth last year. We think they'll finish around $1.5 billion in revenue by the end of 2024. And they could have a reasonable path to $3 billion plus. So there's going to be tremendous growth in China. Now there's going to be a lot of growth. It's really dependent on how it affects how investors view that growth and what multiple they're willing to pay for that growth.
John, when it comes to brands trying to figure out how to succeed in China, I guess what are the biggest differences just in terms of brands that are resonating with Chinese consumers? What are they doing right? What are some of the key differences that you're noticing when it comes to success in the Chinese market versus what retailers are doing who are succeeding here in the U.S.?
I'm sure the Chinese consumer obviously has different preferences and styles than U.S. consumers. Certainly Nike has carved out a very large and successful business in China. So has Adidas in our sector. Lululemon's the most rapidly growing brand in China among that peer set right now. But some of the concerns lies in how fast some of the local China brands are scaling, particularly Li Ning, Anta, Fila, which is owned by Anta. There's other brands rising. So kind of be a little concerned about the rise of the domestic brands in China and their ability to steal market share.
All right, John, we're going to have to leave it there. Thank you so much for joining
Thank
us
you.
this morning. That was John Kernan, TD Cowen's Managing Director of Retail and Consumer Brands. Now, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, retail sales in June came in better than analysts feared, showing consumer strength is holding on, as Gregory Porter would say. And it's Amazon Prime Day. We'll bring on an expert to tell you what you need to know about the sale and give you some smart shopping tips. And finally, President Biden announcing new actions to lower housing costs. We'll talk about what it'll mean for your wallet and how housing affordability will factor into the 2024 election. Plus, it's Media Week on Yahoo Finance, and we're going to dig into the big streamers and what they're doing that's keeping cable and streaming more broadly afloat here. All that and much more coming up on today's show. Well, U.S. retail sales, let's begin there. They were better than expected in June, and they were unchanged while economists were expecting sales to fall by 0.3% in the month. Sales for May were also revised higher. So what does this signal about the consumer? Joining me now, we've got Deborah Weinswig, who is the Coresight Research founder and CEO. Deborah, always a pleasure to grab some time with you here. Just want to get your read in on this retail sales print and what it signals about the consumer right now.
Yeah, I think it was surprising kind of across the board there was strength. I mean, I think furniture and home was weak, but outside of that, everything was, I think, better than most expected. So I do think that we are seeing kind of across the board strength, and it is in the face as well as consumers are planning out further ahead for vacations as well. So they're not only thinking about what they're spending today, they're thinking about what they're spending in the future. And we still saw that strong of a print.
And so with that in mind, where you're seeing the kind of bifurcation perhaps of spending, goods versus services, and how goods, and within this retail sales print, we see even more of where goods may be impacted versus where services, necessities as they may be, are continuing to be spent on. How is that dynamic continuing to play out?
I mean, I think that with kind of some of the lowest housing turnover on record and, with that maybe not changing dramatically anytime soon, we are continuing to see weakness in anything related to the home, just because, right, when you move, you tend to buy new furniture and, kind of new hard lines and soft lines for your home. So that whole category is, and right, the consumer in many cases, replenish that in 2020, 21, and a lot of those items have like a 7-year cycle. So that does make sense on many levels. And so they're kind of saving there, if you will, and then spending, right, there is inflation, obviously, in a lot of the, kind of consumer non-durables and whatnot. And so they are seeing that inflation, but they're able to digest it, kind of taking, kind of like out of one category and putting it into the other. But I think there is a surprising optimism, I think, with where they're spending. I think as they look out 6 months, there is a bit less, I think, of that same positivity, but I think you've got an election and a lot of noise in there as well. And that's driving a lot of, I think, the kind of as people look out into the future and what they say they're going to spend on and what they actually spend on, as you and I know, tend to be different things.
Yeah, certainly. I mean, look, within 1 month away from back to school season at this juncture, which is shocking to think about right now, but that's the reality. I'm looking across some of these divisions, and ultimately, I want to get your sense of what this print and what some of the trends that we're seeing in the strength of the consumer, or even as we had Dana Peterson, who is the Conference Board chief economist, come on and tell us this is a battle-weary consumer. What does this kind of shape up for back to school season even?
And we're definitely seeing people shop early. They're shopping the deals, right? I mean, I think, Target was a week ahead of Amazon Prime, and, they had the kind of lowest prices of the season last week. And so, the consumer's really benefiting here. But I think the retailers are being very, very kind of determined in terms of how they approach this, and understanding kind of where, right, with back to school, not only kind of, not, and back to college, right, those two areas, they're being very focused. And I think that they've seen the data that if you can win that, consumer at that time, as holiday is pulled really early, right into October, and in some cases even late September, that they want to make sure that they have that mind share. And so I think that, and one other thing that I want to make sure we get across is private label is growing exponentially as well. Mm-hmm. And so, right, I mean, consumers are savvy, right? They're frugal, and it's cool to be frugal as well. And so I think that, and if, right, the CPGs and whatnot continue with these, the price gap between branded and private label continues to, right, widen. And so I think that, you go back to an Amazon Prime Day where they're definitely doing an unbelievable amount in, right, their own brands. And we're really seeing that as, I would say, a really key trend that is greater than I think many of us would have expected. And once again, the quality of that product is sometimes better than the branded, right? Lower sodium, lower sugar, more kind of health focused in some cases. And so I think that it is giving the consumer, like, they feel they're empowered. And it's been a long time since they've thought that. And I think that's having a big impact, as we saw in the print today. And I think we'll see that as we look out, to October, which is really where the beginning of the holiday season starts.
And just lastly, while we have you, how could this consumer cycle perhaps shift the retail experience? I mean, we continue to hear about some of the department stores, for instance, that are looking across the square footage that they operate, looking across the products mix and even the head count and trying to figure out, okay, where do we need to start cutting some of this overhead and making for a more seamless experience, both in store, but that also connects to the digital experience that they're powering that perhaps improves margins even more so. How could this consumer cycle reshape the entire way that we experience retail?
That is the excellent question. And I don't think enough people ask it. And what we're seeing is the minute the consumer now hits any friction, they're just kind of really kind of taking a big step back and are really kind of going to a different brand experience, et cetera. And so I think that the level of focus right now on the employee, that, and I feel like there's like a demarcation line between the first half of the year and the back half. And as we think about the volumes that are done in the back half, we didn't necessarily see the consumer say, wow, that was the greatest experience ever. That there is this focus on training, on giving employees kind of more tools to serve the customer, doing what they can to, decrease this turnover in employees and really have, these kind of frontline workers is really like their brand ambassadors, is, creating a much better experience. And I think that the amount of intelligence that retailers and brands can get from their store employees, where does the consumer shop? Where do they want this product? What can we do? They have, right? They don't need to pay for focus groups. They have the greatest one, right? And in their stores. And so I think we're seeing a change. I think there are a lot of these Gen AI solutions that are also starting to be given to the sales associates, and that we will continue to see. We're talking baby steps, but when it comes to retail and serving the customer, those baby steps make a huge difference. And they really do end up driving a happier customer, one who's much less likely to return product, and also one who's much more likely to come back. So I think you're asking all the right questions. I think we're going to see a big change in, let's call it, the next 5.5 months as retailers really focus on this question.
Deborah Weinswig, who is the CoreSight Research founder and CEO. Deborah, thanks so much for taking the time here today.
Thank you. Take care.
You too. Well, it's Amazon Prime Day, and Prime members can get discounts on millions of deals. Amazon saying customers saved more than $2.5 billion in deals last year. So what are the expectations this year? Here with more, we've got Sky Canavis, who is the eMarketer Principal Analyst for Retail and E-commerce. Great to have you here with us. Okay, so first and foremost, what are the expectations going into this year, knowing, as you just heard in our previous conversation, some retailers started their deals and tried to flank earlier than Amazon, some of those trying to also capitalize on the same type of SEO and traffic online that Amazon has really started, and many of the other retailers kind of added onto or annexed themselves onto as well?
Well, this year, when it comes to Prime Day, Amazon's really sticking to what's worked for it before and what continues to work for it. And that's really centered around offering those compelling deals and benefits for Prime members to highlight the value of Prime membership and drive more signups. And that continues to work. We forecast that Amazon will add more than 5 million Prime users this year for a total of more than 181 million. So that's more than 2/3 of the US population. So to experience continued membership growth on top of those existing levels is really striking. And when it comes to Prime Day, Amazon still sets the agenda and takes the majority of sales. So we expect that US consumers will spend nearly $14 billion online during these 2 days. And nearly 60% of that, or more than $8 billion, will take place on Amazon. And that 60% is much higher than Amazon's average of e-commerce for the year in the US, which is around 40%.
So which categories typically outperform? What are expected to be those biggest deals or the categories that see the most traffic this year?
We've seen a lot of interest in essential goods categories, especially starting last year with Prime Day and this year with their big spring sale. So things like food and beverage and health and personal care have been really strong on Amazon. And beauty is an area where Amazon has called out a lot of new to Amazon brands like Clinique and Kiehl's. And beauty is a category where Amazon's online sales continue to outpace overall e-commerce growth for the category. And it's been a very strong, resilient category, and one where brands are keen to get on Amazon because so many consumers are there looking for beauty products. And if the beauty brands aren't selling them, then third-party resellers will.
All right, shoppers.
And we'll also see a bit of uptick in the small consumer electronics, things like headphones and accessories, chargers, and back-to-school shopping as well.
Shoppers, they of course are all about the deals right now as they're looking for value hacking opportunities, but they're also looking to just smart spend. And so with that in mind, what are some tips that can help people save more money and spend smart?
I think the most important is to plan ahead and consider what shopping needs can be met during the Prime Day sales, whether that's back to school or getting a jump start on holiday shopping or looking at stocking up on essentials. That's really important, and thinking about what specific products are needed to avoid distraction and FOMO around the lightning deals. Shoppers should be reading up on the deals that Amazon's announced for specific products and brands. And this year, they're back with special invite-only deals for a limited selection of products. The Amazon devices and brands usually have the steepest discounts because Amazon has the greatest leeway in their pricing and uses those to get shoppers in the door.
Sky,
if shoppers...
Yeah. Sky, we got to leave things there on the day, but we're going to be tracking very closely, as we know you will, across all of the results of these past few days of power shopping here. Sky Canavis, who is the eMarketer Principal Analyst for Retail and E-commerce. Sky, thanks so much for taking the time.
Thanks for having me.
Certainly. Credit card delinquencies are on the rise, according to the St. Louis Fed, and we won't have updated figures for the second quarter until later on this summer. But bank earnings are giving us an early look at delinquencies. Most recently, Bank of America reporting earnings today, and credit card delinquencies are up quarter over quarter and compared to last year. Other commercial banks like JP Morgan, Citi, and Wells Fargo echoing the same. To discuss this further, we've got Yahoo Finance's very own David Hollerith here. David, I mean, this has been a blitz of a past few days for you here, so take us in to what we know so far about some of these credit delinquencies.
Hey, Brad. Yeah, now with Bank of America's results, we have basically the credit card data for all the major banks, or all the country's 4 biggest banks, and that gives us a more complete picture of the consumer, obviously. And what we saw this morning with Bank of America is that they did see higher write-offs on their credit card loans. They actually pointed to that. Credit card write-offs turned out to be worse than commercial real estate, as they had pointed out in the call. CFO Alistair Borthwick, who we spoke with earlier today, had pointed out that the bank is beginning to see a weakening of newer credit card customers, but that the losses are also beginning to flatten out. And that's something that's been seen across all of the 4 big banks, which is that there's been a plateauing compared to the first quarter. Now, a lot of that is being attributed to seasonality, but it could also be a good sign of where the consumer sits. If we zoom out a little bit, the situation is that of a weakening consumer for the past 2 years, and it's coming off of a period where there's actually really good credit for the consumer, really low delinquency rates. So I think other things that are worth probably highlighting here, that the combined charge-offs or write-offs of bad credit card loans for the big 4 banks was about $5.3 billion, and that's just by our math. And that's a rise of 7% from last quarter and 39% jump from a year ago. So again, the pace seems to be slowing, but that doesn't mean that credit card delinquencies aren't.
So with all of this in mind, David, take us into the outlook here. What are the banks saying about the rest of the year?
Yeah, so I heard it most from Bank of America this morning is that they expect a flattening out in the second half, if not a decline in credit card delinquencies, which has a lot to do with their expectation for what the Federal Reserve might do. and every other thing that could have to do with economic activity rebounding. But that being said, there is just a seasonality thing at play where the first quarter is usually the worst. Second quarter is also not great. First half is generally better. So we'll see if it follows that trend. CFO Alistair Borthwick of Bank of America, again, pointing out to us that buying any kind of economic downturn that is not foreseen, he expects credit card delinquencies to be lower in the second half of the year.
All right, Yahoo Finance's own David Holliver, thanks so much for keeping tabs, dialing into some of these earnings calls and getting conversations on the record with a few of those C-suite executives over at the banks. Appreciate it, David. Let's switch to Homebuilder confidence. We've got much more on this as Homebuilder confidence ticked lower in July. We'll discuss the latest National Association of Home Builders report right after this short break. Stick with us. Home builder confidence in July reaching the lowest level since December of 2023, so Q4 last year. Confidence for newly built single-family homes is a reading of 42 for this month. That's down a point from June, according to the National Association of Home Builders. To discuss, let's bring in Jim Tobin, who is the National Association of Home Builders CEO, here in studio with us. Great to have you here.
Great to be here.
Absolutely. Take us into what's driving this decline that we've seen. And as we mentioned, lowest level that we've seen since December of 2023. Of course, December usually sees some cyclicality within that print. Right. But why now during what should be one of the home buying months here over the summer?
Yeah, we've erased all of our gains from the second half, or the first half of this year. That's really what the shame of the last 2 months has been. Really what's driving is interest rates. Interest rates continue to be stubbornly high. We're right under 7% for a mortgage rate right now, and that's really stifled the market. It's been the story over the last couple of years. And while there was some optimism coming into the new year, we saw that reflected in our numbers when we crept back over 50 for the first time in a while. We've retreated over these last 6 months. So not surprising that just the demand is being suppressed by mortgage rates.
How many rate cuts do you believe that we're going to need to see in order for home builders to regain confidence?
Well, I think a couple of things. We expect certainly one by the end of the year, probably two now. We're really thinking that Chair Powell seems to be indicating that maybe inflation is starting to tame and track in the right direction, in which case maybe we'll get two, but they're going to be small. We know this. We think the major rate cuts are going to come next year, 4 or 5 perhaps next year. We're really going to need to see those rates come down to mid-6s, because the other part we don't talk about mortgage rates. One of the lifeblood of home building is AD&C lending, acquisition, development, and construction lending. That's up about 13 or 14%. When rates start really to retreat, that's when we're going to see a commensurate lowering of those construction lending rates as well.
What are some of the hottest markets that you're tracking right now for builders?
Still the Southeast,
yeah.
really, the Dallas market, Houston, Austin, and Texas, sweeping across through Alabama into South and North Carolina, and then of course Florida continue to be the hottest markets.
As you think about new home buyers, and especially for family formation or job relocation, that typically tends to be the mindset that can drive some of these new home purchases, whether that be home builds or existing homes. But as you're focused on where new homes have really taken on more than the historical average of the percentage of the broader home market, where do you see that continuing to trend to here?
Well, we saw a run up right after COVID in some of the smaller markets like Boise, Idaho. We saw a big run up there. In Coeur d'Alene, Idaho, Austin was one of the hottest markets in the country. Those have cooled down, as you would imagine. But what we think we're going to continue to see is the areas where you have a lot of economic growth. We think of Texas, think of the Southeast again, where people are going to look for those new jobs, where they're going to be, for lack of a better word, forced to buy new construction or move because of a job situation. That's what's going to drive new construction.
One of the huge things that we think about is the dynamic between affordability and what's keeping people on the sidelines as well. And one of the things is affordability, but then at the end of the day too, it's where kind of that's overflowing people still to remain in the rental space. And perhaps I'm just, speaking from my own personal experience right now, but there are many like myself who continue to rent because home ownership doesn't make sense at this rate right now. I wonder how you're evaluating that dynamic.
Yeah, I mean, for us, rent and ownership, I'm a big believer that ownership is the gateway to the middle class in this country, right? You save for your down payment, you build equity into a home and grow your family, or perhaps you buy a second home or a larger home. And until we see those numbers where homeownership really is that much better than renting, people are going to be locked in rental for a long time. And we're going to see that shift. Once interest rates sag down, and we get more into that low 6s and high 5s over the next, we think it's about a year and a half that we're going to see that decline. Then we're going to see the existing market unlock, and that's where we're going to see a rush back to ownership.
You've got even more news coming out. President Biden unveiling a new plan today to cap rental increases at 5% nationwide. I want to get your reaction to that.
Yeah, we're absolutely opposed to rent control. It doesn't matter because what we find is economically it doesn't make sense. It will stifle new construction at a time when we need more rental production. If we're going to lower rents, we need to do it the old-fashioned way, which is put more supply on the marketplace and meet demand where it is. Rent caps, all they do is, I believe they really do suppress construction. But what you have to remember is costs continue to rise for landlords. Whether it's insurance costs or through the roof, whether it's just maintenance on a building. If you cap rents, it doesn't allow them to put the maintenance back in the building and service those buildings and ultimately their renters. I think it's a lazy policy. I think if you truly cared about lowering rents across the country, the president would find ways to increase production. That means, and the president has talked about supply. He's talked about trying to use the federal levers to get local governments to lower their regulations on housing and lower costs. But this one flies in the face of that. I got to be honest with you, when I talk to people in Washington, D.C., the policymakers, they're not really pushing for this. Economists on both sides of the aisle think rent control is not the method to lower rents. This is being driven by the politics of the moment, and it polls well. Let's be honest. People hear the rents are going to get capped.
Is part of the issue that market rates are misrepresented by a lot of landlords or owners of properties where a tenant can be paying something that's far lower, and that should be the actual rate that is represented in filings, but it's not.
But it's not. And I think we have to remember too that almost 50% of the rental apartments owned in this country are owned by what I would call mom and pops, not big corporate landlords, which is what the president has circled as the populist answer to this. But there really is. It's going to hit people in the pocketbooks, and I know the president's trying to target it to corporate landlords, but it's still going to stifle because. In our mind, he has to go to get an act of Congress. I promise you, we will be fighting this tooth and nail on Capitol Hill to make sure this never sees the light of day. However, even though it's a 2-year rent cap, I know the way Congress works, and they always extend things. So we don't even want the Campbell's nose under the tent here.
Jim Tobin, National Association of Homebuilders CEO, here in studio with us. Great to finally have you here.
Thanks for having me.
Absolutely. Well, the Biden administration, as we mentioned, unveiling new actions to help lower housing costs. The president calling on Congress to pass legislation capping rent increases at 5%. Now, this would apply to landlords with over 50 units in their portfolio and provides an exception for new construction and renovation or rehabilitation. Another action involves repurposing public land to build affordable housing. Joining me now is Chen Zhao, who is the head of economic research over at Redfin. Chen, great to have you here with us this morning. Want to also get your reaction here to the latest unveiling of this plan from the Biden administration.
Thanks so much for having me. Yes, I completely agree with your previous guest. I think like most, if probably not all economists, rent caps do not really make much sense, in my opinion. They are very appealing in the short term for renters, but in the long term, they don't really address the root cause of the issue. And the root cause of our affordability issue in housing is a severe lack of supply. So the way we get out of this is to encourage more building. And President Biden does talk about that as part of his proposal, repurposing federal land, for example, to build more affordable units. So that is definitely a step in the right direction, even if it's only, kind of makes a difference at the margin. But rent caps only work to suppress supply in the long term because it doesn't create the right incentives for builders. So in the long term, it only exacerbates the problem.
With that in mind, as we're thinking about where different cities have already because there's the federal level and then there's the state and local level where they've already put into effect some of their own rent stabilization or rent control mechanisms. Are there states that are doing this well that this move from the administration should actually more mirror than doing a sweeping action like this?
I mean, as far as rent stabilization or any sort of measure capping rents, I think across the board, those are generally not a good idea. So I would not encourage any sort of federal action to emulate any of those sorts of local actions. I think states that are trying to address the supply problem are something that we should be paying attention to. So, for example, California allowing ADUs to be built, in the, backyards of, existing single family homes, for example, that increases supply. And those are things that homeowners can rent out. So that is something that we should be paying attention to.
Yeah, accessory dwelling units, just for all of those who, of course, even as I try to remember all the acronyms around and tickers that we're covering every day, just helpful for those out there. Additionally here, I want to talk about a new report out that Redfin has today that says in swing states, typical monthly payments for a home buyer has nearly doubled since the 2020 election. Tell us more about some of the findings here.
Of course. So what we have seen in our calculations is that the mortgage payment that is associated with a median price home in a swing state has gone up 92% since 2020. And the reason for that is because home prices have gone up more than 40% and mortgage rates have more than doubled in that time. So that's really driving the increase. And what that means for homeowners or people who are wanting to buy homes is that for a family making the median household income, they would have to spend 33% of their income now in order to buy a median priced home. And that is up from 22% 4 years ago. And if we look at the supply side, what we see is that just about 1/3 of homes that are available for sale are affordable to a household that's making the median income. And that is down from 2/3 4 years ago. I'm sorry. So all across the board, by all of these different measures, what we're seeing is that affordability has really just become a real problem for people across the country, and also particularly in swing states.
I mean, we think about 2020, of course, and the year that was, and of course, rates dropping to zero, cut in order to make sure that there was a spurring of demand. And ultimately, between 2020 and 2021, there were a lot of new homes that were purchased because rates were so favorable. I wonder, how much adjustment needed to be taken into account here when looking at the difference in mortgage rates and mortgage payments that are being made.
Yeah, so there are both of those things. It's both home prices and mortgage rates that's really driving this huge increase in housing cost. So another way to think about this is that home prices actually also went up a lot between 2016 and 2020. They also went up about 40%. As they did between 2020 and 2024. But the difference is that mortgage rates did not go up between 2016 and 2020. But between 2020 and 2024, we went from ultra low mortgage rates to now, high 6s, 7% mortgage rates. And that's really driving the difference between those two time periods.
Really great context there. Chen Zhao, who is the head of economic research over at Redfin. Chen, thanks so much for taking the time.
Thanks for having me today.
Certainly. Everyone, we've got much more wealth after the break. You're watching Yahoo Finance. This week, Yahoo Finance is taking a deep dive into the media industry as part of our Yahoo Finance media streaming and investing. What's next? Today, we're focusing on streaming versus cable as the landscape across the media industry continues to change. Yahoo Finance's Alexandra Canal joins us with the breakdown. Hey, Ali.
Hey, Brad. And yes, it's been a question for a few years now, right? Is linear TV dying? And the answer, unfortunately, for these cable companies is yes. And a lot of it has to do with this migration that we're seeing in advertising. Back in the day, ads were always the gold standard with cable. That's how these traditional TV networks made the bulk of their revenue. But we're now seeing this transition from linear to digital platforms like streaming because ad buyers, they ultimately want to meet the consumers where they are. And you can see this transition very clearly in the earnings reports from these traditional media companies, with pretty much all of the major players seeing double-digit declines in linear ad revenue. Sports can certainly be seen as a lifeline here. Obviously, the Super Bowl, that led to a significant amount of ad revenue for CBS, which is owned by Paramount. But even sports is now migrating towards streaming services, with NBC's Peacock and even Netflix securing exclusive NFL games for this upcoming season. On top of that, ad buyers now have a lot of options, with ad-supported tiers pretty much the norm across the entire streaming market. Amazon most recently got into that ad tier game by automatically converting all of its Prime Video memberships to ads. If you don't want those ads, you're going to have to pay up for the ad-free version. But what we've seen through various third-party data sites is that a lot of these consumers, they actually prefer saving money and selecting those ad tiers. It's been seen as a value play for consumers, especially in a time of high inflation and high interest rates. That's also why we're seeing this rise of FAST services, otherwise known as free ad-supported streaming platforms like Pluto TV, along with Tubi. So it's really this full circle moment, Brad, where we're seeing ads come back into vogue. And judging by the data, judging by the impact that advertising has had on revenue, won't be going away anytime soon.
All right, stick with us, Ali. We've got much more discussion on this. Despite consumers seeing a wave of price hikes in their streaming accounts over the last year, companies are also doubling down on cheaper options. Streaming giants like Netflix, Hulu, and Disney Plus are all pushing ad tier options as users look to cut costs. But what does this mean for the broader media landscape? Marcus Collins, University of Michigan marketing professor and author of For the Culture, joins us now alongside Yahoo Finance's Alexandra Canal. Marcus, great to have you here with us. I mean, let's dive right in. As we're thinking about the different ad tiers and where streamers are trying to be very specific about their offerings towards the consumers, where are consumers gravitating towards some of these options and in what types of content as well?
I think they're being driven by cost for sure. There's a cost sensitivity there, but there's also a sense of where are my shows, right? So the premium content that's more aligned to the shows I like to consume, that's where I go. And unlike cable, where you're locked in over time, people go, I will have this subscription for this offering until my show is done, then I'll cut bait and go somewhere else. So there's just a ton of dynamism in the marketplace that we see when we look at the numbers that are projected and are realized with regards to how viewership is going up and where people are putting their money.
Hi, Marcus. Great to see you again. Do you think advertising will continue to be a growth driver in the long term? Because we've certainly seen the potential baked into the stock prices, like a company like Netflix, for example. But could there be a subscriber shift at some point? And could we see perhaps some disappointment when it comes to the success of advertising?
I mean, I think that marketers and brands underwrite everything. Right. So it's no surprise. It's interesting. The irony of all this is that the streaming model is essentially getting closer to a cable model, just augmented with the agency of allowing subscribers to put up more money to circumvent the ads or to say, I'm going to take the ads so that I don't have to pay. Essentially, what this is getting to is the closer and closer we get to providing consumers more agency, more flexibility, and more freedom, the business models that are built for that will be the ones that essentially will win out in the end, just as you can see the numbers of linear TV continuing to decline.
Also, what's interesting is that we're seeing this push for more sports and live events on streaming platforms. How do you think that can impact advertising?
Well, I mean, we have been conditioned, thanks to streaming, to be less inclined to watch things synchronously, right? We don't have to be shoulder to shoulder. We don't have to be watching concurrent. And there are only a few moments in time where we want to concurrently consume a thing, and that is sports, full stop. So as sports continue to sort of lean and tease and visit the streaming world, it creates more value for those places. That was always sort of the holdouts, that I'm not going to go fully offline. I'm not going to fully cut the cord because I want to watch sports. Well, if sports are going to be where I already am, then it creates a much more compelling offering when it comes to streaming. And for marketers, they're already investing money in sports as a sponsor. Now you've got the best of both worlds happening with regards to how they do their spend. They're where the people are, they're in the properties that matter most, and they're doing it while people are watching it concurrently.
Netflix has basically set itself as the standard. Activist campaigns have even elucidated that, where you have activists looking at Disney even and saying, why can't you be more like Netflix? And so who is the not just industry standard, but best positioned from a margin perspective as well, even as they're trying to squeeze out the most dollars that they can from consumers?
I think Netflix still remains in a powerful position. If you just look at the earnings, I think it's testament of that. But Netflix does a few things really, really well. They have a volume of content that oftentimes doesn't require as much resources to make, right? It's far cheaper to make, a reality TV show that streams only on Netflix, like Love at First Sight, than it is to make a Mandalorian, right? And since Netflix has that kind of heterogeneity in their offering, they're able to kind of hedge their bets with regards to where they'll spend their money to realize the greatest margins. Not only that, the viewership is there. There's so much content there that they create sort of a better product market fit for consumers, and they're getting into the sports business with WWE. Like, they're in all the places doing all the things and sort of hedging their bets in the best ways possible.
Just lastly, while we have you here, I want to switch gears just for a hot second, Marcus. We're also in an election year. And as we've discussed in the past, how critical social media is in the role that it plays here. I mean, as we're thinking about even the events of last weekend, the proliferation of misleading content and the different divisive narratives that come about, how critical of a year is this, not just for social media to continue being a reliable community, but also in its own importance for the outcome of the election?
Yep. Social media is the media of people. By definition, social means people. Social work, social justice, social action, social welfare. It's all about people. So the media of people is what's driving the discourse that ultimately influences behavior. There is no marketing more influential than us, right? We trust people over any form of marketing communications. So with regards to what we watch, from a streaming perspective, where we're going to vote, where we should be putting our efforts, what matters, whether we're Team Kendrick or Team Drake, all these things are being influenced by our people. So social media as a platform, as a technology, will be unbelievably valuable in every step forward, because we will be collectively deciding as a community, as a culture, what's acceptable for people like us. And those things are being mediated, negotiated, and constructed through our discourse on social networking platforms.
All right. And one of the major owners of one of those platforms is donating and throwing his own money into the ring as well here. So we'll see how this all nets out. Marcus Collins, who is the University of Michigan marketing professor alongside Yahoo Finance's Alexandra Canal. Thank you both.
Thank you much.
Coming up, is the federal government doing enough to ensure citizens are set up for retirement? We're going to discuss on the other side. Are you doing enough to save for retirement? This year marks the 50th anniversary of the Employee Retirement Income Security Act, or ERISA for short, which is aimed to protect and better protect private sector pensions. But with less than 20% of workers receiving a pension, could the federal government be doing more to help Americans get set up for retirement? For more, let's bring in Mark Miller, who's the Retirement Revised publisher and editor. Mark, thanks for taking the time here with us today. Okay, so this is a significant milestone, and we've seen kind of very few significant eras of retirement options and mechanisms presented to Americans. Where do we stand right now from your purview?
Yeah, we thought that it was an opportune moment to kind of assess where we are 50 years after the passage of this landmark legislation that really kind of set the stage for the system we have today, which, as you mentioned, really we've had a shift away from the old-fashioned traditional pension, which worked in a fairly automated fashion, to one that is much more driven by the individual participating in the 401k system. And so it was an opportunity to look at what's working well there and where are some opportunities for further improvements.
What is working well with 401k? And then I guess on the other side, to a certain extent, where and which industries perhaps do pensions remain most relevant? Right.
Well, with respect to traditional pensions, it's worth saying that almost everybody who works in the public sector still has them. You know, people who work for state and municipal government very likely have a traditional pension. They're down to a very small percentage of the private sector workforce, however. And so, you know, in its place has been the rise of the defined contribution 401k style. And what we see there is that is working very well for higher income people and people who work for larger companies that are the most likely to offer 401ks. One of the things about 401k is that at any given time, only about half of workers are actually covered. And the part of the economy that's least likely to have coverage or be offered a plan are people who work for small companies. So that's really a stark reminder that we are really not offering enough people the opportunity to put away money for retirement.
And so you talk about the government needing to do more here. So when you think about how and which mechanisms they could put into practice, put into law even, and bring forward to the American people, what would they be able to bring forward that wouldn't so radically change retirement savings that have already been amassed thus far?
Yeah, the idea that's been kind of rattling around for more than 10 years is the idea of a so-called auto IRA, basically a government-sponsored IRA program for people who don't have workplace coverage. That, you know, if an employer doesn't offer a plan of their own, they'd be required to enroll their workers in this government-sponsored IRA. Now, that's an idea that was first proposed during President Obama's first term, and it didn't get signed into law. But 17 states have taken up that mantle and passed legislation of their own to create these plans. And about 8 states have actually launched them, including some big states like California and Illinois and Maryland. So it's gathering steam there. Some have proposed bringing this idea back up at the national level, an IRA program. And the most robust, most ambitious version of this would essentially be a government-sponsored 401k plan, where not only would people have a government-sponsored place to save, but there'd be a government matching contribution as well, and other features such as low-cost investment options. So there's kind of a range of ideas out there that would help close this really big gap in coverage. So this is one area, you know, that would bear some, I think, you know, should be looked into.
Just briefly, what type of delta in savings, perhaps, would a plan like this mean?
Well, you mean what kind of savings would be possible? I'm not sure I'm following.
Yes, accumulated savings versus what's existed, I mean, thus far, you know, over the past 10 years since this has been kind of brought up by the Obama administration.
Yeah, I mean, one of the problems with this, I think, this whole idea is that I worry that it doesn't get us to solutions at large scale. And the reason I say that is, in addition to the coverage problem, when you look at households with kind of middle income households and lower income households, there's not the wherewithal really to save large amounts. So I think that plans like this can move the needle somewhat. And I think, they're good to do because, saving is good and people should be saving if at all possible.
Yeah.
But I actually think that there are other opportunities out there to move the needle in a much bigger way. And I talk about this in the story as well. And specifically here, this is the notion of expanding Social Security with a specific focus on expansion of benefits for lower income and median income households. I think that that's a way to really move this system at scale as opposed to kind of a very incremental approach.
Mark, we got to have you back on to continue this discussion sometime. Mark Miller, who's the Retirement Revised publisher and editor. Thanks so much for taking the time.
My pleasure. Thanks for having me.
Coming up, everyone, UnitedHealth Group, the largest health insurance company in the U.S., gave an update on its data breach in its latest earnings. We'll tell you what you need to know next on Well. UnitedHealth Group reported earnings today and offered an update on how that massive data breach that they had earlier in 2024 impacted their business and their customers. Here with the latest, we've got our very own Anjali Kamlani. Anjali, what did they say?
Well, we do know that that breach is still being analyzed by the company. They will not have an exact number on how many folks were impacted until the end of the month, and they're going to be starting to send out those notices. We also know, of course, by now that credit monitoring is really the only way to kind of tell if anything has happened. Now, just to recap, the impact for the company is also greater than expected. So that's also something new we found today. $1.1 billion just in the second quarter alone for the company, and that played a role in why they just slightly missed estimates on their revenue. That cost of impact is a majority of what they had initially estimated as the full year impact, which was $1.6 billion, just to give you that sort of context. So looking at the broader space, the company is still waiting to find out the impact itself, as well as let customers know. We also know that on the Medicare side, they have been looking at just what the CMS reimbursement will be for the upcoming year and how that's going to impact how they price the plans, as well as how they design those plans. So that's going to be something to take into consideration. Whether or not all of this translates into higher premiums for insured individuals, especially on the commercial side, will remain to be seen, depending on how the second half of the year goes. So if things taper off, if utilization slows down and they can get back to normal on their payments, should all be good.
Switching gears a bit while we have you, Anjali, recent data showing more COVID-19 activity levels. What can you tell us about
That's right. With the Secretary of Health himself testing positive today, we do know that, of course, COVID has not gone away, and we're starting to see what is becoming pretty normal, which is a summer wave of COVID. We've seen a spike, according to CDC data, pointing to the KP3 variant, now counting for a quarter of cases, and that is one of the variants associated to an earlier version of JN1. We've seen about 40 or so states reporting some level of activity, so really a majority of states there, as you can see on your screen. And so just as a note, stay safe. We've also seen the bringing back of masks at the...
I have seen that.
Yeah.
Yeah, a few more people. All right, so stay safe out there, everyone, even during the summer season where we're all outside. Anj, thanks so much. Everyone, that does it for Wealth here today. I'm Brad Smith. Thank you so much for watching. Guess what? You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. They got you at 3 p.m. Eastern. They're counting you down to the closing bell and through it. You don't want to miss it.